Exploring crypto adoption, trends and predictions for 2025. Crypto adoption is on the rise, but what's really driving its growth? From empowering the unbanked to hedging against inflation, the reasons are as diverse as they are compelling. But here's where it gets controversial. While some governments embrace digital assets, others remain skeptical. And this is the part most people miss. The real-life applications of crypto are expanding in ways that could reshape our world. Let's dive into the details of this complex landscape. At its core, crypto adoption refers to the integration of digital currencies like Bitcoin and Ethereum into our daily lives and financial systems. This goes beyond mere speculation. It's about using these assets for payments, investments, and accessing decentralized applications. From businesses accepting crypto to governments exploring blockchain technology, the use cases are growing rapidly. But what's behind this surge in adoption? Economic conditions, regulatory clarity, and access to digital infrastructure all play a role. In developed countries, institutional demand is a key driver, while in emerging markets, it's often about financial access and stability. For example, in regions with limited banking services, crypto provides an alternative for savings, transactions, and business operations. Stablecoins, in particular, are gaining traction as a means to manage inflation and navigate foreign exchange shortages. Decentralized finance, DeFi, is also making waves by expanding access to credit and savings tools, reducing the need for traditional banks. This is especially relevant in areas underserved by legacy financial systems. As adoption grows, crypto is increasingly seen as a tool for financial inclusion and economic resilience. But perhaps the most intriguing development is the tokenization of real-world assets. By representing assets like real estate or art as digital tokens on a blockchain, new avenues for ownership and investment are opening up. This process, known as tokenization, allows for fractional ownership and improves transparency through on-chain record-keeping. From tokenized bonds to digital art, this trend is reshaping how we store and transfer value. Of course, the path to mass adoption is not without its challenges. Market volatility, security risks, and regulatory uncertainty remain significant hurdles. For crypto to gain broader acceptance, these issues need to be addressed head-on. Despite these obstacles, the future of crypto adoption looks promising. Experts agree that regulatory clarity is key to unlocking the next phase of growth. As legislation evolves and practical use cases emerge, crypto is poised to play an increasingly important role in our global economy. From supporting rural energy projects to enabling cross-border payments, the potential applications are vast and varied. So, what does the future hold for crypto adoption? The answer is complex and multifaceted, but one thing is clear: this technology is here to stay. As we navigate this rapidly changing landscape, one question remains: are you ready to embrace the future of finance? Indian HNIs turn to cryptocurrencies after US reforms. What's driving the rally? High net worth individuals, HNIs, in India are increasingly turning to cryptocurrencies, fueled by recent developments in the United States. This shift is not just a trend, it's a significant move that could reshape the investment landscape in India. On Friday, former U.S. President Donald Trump signed the newly passed stablecoin bill into law, declaring that the crypto industry would become stronger, bigger, and better than ever. This legislative action has had a profound impact on global crypto markets, including India, where Bitcoin has set new records this week. Public sentiment has been steadily improving since the tariff-induced sell-off earlier this year, and there's a growing anticipation of a sustained bull run. In India, the crypto rally has attracted a growing number of HNIs. We've seen a significant influx of HNI clients jumping into the crypto market, said Edul Patel, CEO of Mudrex, in an interview with Money Control. Bitcoin ETFs are at an all-time high, with capital inflows of $70 billion, and the value of these investments has doubled to over $150 billion in just 18 months. Even gold ETFs haven't been able to match such returns in 20 years. This surge in interest is evident on various trading platforms. For instance, Mudrex reported a 30% increase in HNI trading volume within a week, reaching $10 million. CoinDCX, another prominent exchange, observed a 25% to 30% rise in the average per trade size of HNIs in July, up from around 5 rupees lakh in June. The platform has noted that nearly 50% of its total trading volumes are driven by over 3,500 HNIs, family offices, and institutions, with an average monthly trading volume of more than 50 rupees lakh on spot markets. But here's where it gets interesting. Exchanges like CoinDCX, CoinSwitch, Mudrex, and ZebPay have seen a significant surge in participation from Indian family offices. Many of these investors are gravitating towards established blue-chip tokens like Bitcoin and Ethereum. However, there's also notable interest in other cryptocurrencies such as Solana and Ripple, while memecoins like Dogecoin, Pepe, and Shiba Inu are also attracting attention. Current crypto regulations in India. India legalized trading and holding of cryptocurrencies in March 2020, albeit with certain caveats. A 30% tax on profits from sales, trades, or spending applies, along with a 1% tax deducted at source, TDS, on transactions exceeding 50,000 rupees per financial year. The government classifies these digital assets as virtual digital assets under the Income Tax Act, but they are not recognized as legal tender. Unregistered exchanges and wallets are prohibited, and Know Your Customer, KYC, registration is mandatory for all crypto transactions. The lack of clear regulatory guidelines and high taxation rates have made many investors cautious about crypto trading in the past. However, the tide seems to be turning. Prominent exchange platforms have reported a dramatic shift in public sentiment this year, with Indian HNIs making balanced, smaller investments on a monthly basis. #US Crypto Week Rally. The current U.S. administration is marking Crypto Week, with the House passing 3 key bills aimed at boosting the legitimacy of the cryptocurrency industry. The Genius Act, signed into law by President Trump, is the first of these measures. The other 2 bills, one proposing a new market structure for cryptocurrencies and another prohibiting the Federal Reserve from issuing a digital currency, will now move to the Senate. And this is the part most people miss. While the US is taking steps to regulate and legitimize the crypto industry, the impact on global markets, especially in countries like India, is significant. As the US continues to shape the future of cryptocurrencies, it's worth considering how these changes might influence the investment strategies of HNIs in India. What do you think about the growing interest of HNIs in cryptocurrencies? Do you believe that the new US regulations will have a positive impact on the global crypto market? Share your thoughts in the comments below. Gold to Bitcoin: why India's wealthy investors are embracing crypto in 2025. In a surprising shift, India's affluent are increasingly trading their traditional gold investments for the digital currency Bitcoin. This trend marks a significant departure from centuries-old investment practices in the country, where gold has long been revered as a symbol of wealth, security, and cultural heritage. The allure of Bitcoin for India's wealthy is multifaceted. According to Edul Patel, CEO and co-founder of Mudrex, the global resurgence of interest in cryptocurrencies following the US elections has bolstered confidence in digital assets. In India, high-net-worth individuals, HNIs, and family offices are now viewing cryptocurrencies as a valuable addition to their diversified portfolios, primarily for hedging and diversification purposes. At Mudrex, approximately 30% of trading volumes now originate from HNIs, who typically allocate 2 to 5% of their investment portfolios to digital assets such as Bitcoin, Ethereum, and Solana. These 3 cryptocurrencies alone account for nearly 70% of their digital investments. One of the key factors driving Bitcoin's appeal is the increasing institutional interest and the establishment of clearer regulatory frameworks. As the cryptocurrency market matures, Bitcoin's notorious price volatility has begun to stabilize, making it a more attractive long-term investment option. Sumit Gupta, co-founder of CoinDCX, notes a significant shift in the mindset of wealthy Indian investors. The conversation has evolved from questioning the merits of investing in cryptocurrencies to determining the appropriate allocation within a well-diversified portfolio. The launch of Bitcoin ETFs by major global entities like BlackRock has further bolstered trust in Bitcoin, signaling its growing acceptance in mainstream finance. Despite the potential rewards, India's wealthy approach Bitcoin investments with caution, fully aware of the inherent risks and volatility. Typically, they limit their cryptocurrency allocations to 2 to 5% of their overall portfolios to maintain stability. Himanshu Maradia, founder and chairman of CIFDAC, highlights Bitcoin's impressive historical returns, which average nearly 70% compound annual growth rate, CAGR, over the past decade. This performance has caught the attention of HNIs seeking higher returns than what traditional gold investments can offer. The younger generation within affluent Indian families is often the driving force behind the adoption of cryptocurrencies. Being more technologically savvy and open to new investment avenues, they frequently initiate discussions about incorporating digital assets into the family's investment strategy. While Bitcoin offers exciting prospects, it is not without its challenges. The cryptocurrency's price can fluctuate dramatically, with annual volatility 4 times that of gold. Additionally, India imposes a flat 30% tax on cryptocurrency gains and a 1% tax deducted at source, TDS, which can erode profits. To mitigate these risks, HNIs employ strategies such as careful position sizing, secure storage, and professional advice to avoid hacks or errors. Experts believe that Bitcoin will not replace gold but will coexist as an alternative investment option. As regulatory frameworks become clearer and digital infrastructure improves, allocations towards Bitcoin are expected to increase, particularly among younger HNIs and forward-thinking family offices who view it as the digital gold of the 21st century. In conclusion, the growing interest in Bitcoin among India's wealthy represents a fusion of traditional and modern investment strategies. Rather than displacing gold, Bitcoin is emerging as a complementary asset, offering a digital, scarce, and borderless alternative. This trend underscores how India's affluent are embracing innovation to shape the future of wealth management.